Robschild, no investment advice. Welcome to the show where we view financial markets through crystal ball gazing. JP Morgan once said, millionaires don't need astrologers, but billionaires do. And so we begin. I wanted to get today's show out of the way early today. It's only almost 1 p.m. Eastern Daylight Savings Time right now as of the recording of this show. I just need to get this done earlier today. Today is Friday, August 2nd, 2024. Today's episode, the SOM rule has been triggered and the recession has started. So what that is that the unemployment rate has now risen above its 3-month moving average, something like that. I'm not sure what the exact numbers are there for that, but all I know is that it's been triggered, and I very correctly, had been noting and saying in most of my recent shows that although the last and the expected reading for this report was at 4.1%, I was saying, is it going to be 4.2 or even worse at 4.3? And it was 4.3. So I can give myself a pat on the back for seeing this one coming. Again, we're at the part of the cycle now. We've been in the part of the cycle where the market kept surprising people to the upside, right? Earnings kept coming out stronger than expected. Employment kept coming in stronger than expected. Inflation kept holding up way higher and then way longer than expected. And now in my opinion, we're on the other side of that coin. The pendulum swang one way, and now we're swinging the other way. And I think that we're going to be seeing that, especially in long rates, which is why I have been beating the drum about, being long duration treasuries for forever, and that's finally looking like it's beginning to play out to an advantage for those of you that are long treasury bonds. Again, no investment advice. Adding to the messiness of today, the U.S. employment report for July came in at much weaker than expected and much weaker than the last. So people are getting less jobs, and people that want work are having more and more trouble finding it. Again, 4.3% is not super high, but the direction that it's been going, it's spiking right now. And pretty much everybody out there agrees that we kind of fully expect, including myself, the Fed to be behind the curve, as they always are, as they were before inflation got out of control. They did not raise rates fast. They kept rates too low for too long, and then they raised rates. And now we're at the point where they held rates too high for too long, and they'll be chasing the market down. It's just a matter of how far that goes, and I think it'll be pretty far because of how aggressive the hiking cycle was and for how long these rates have been so incredibly restrictive. One of the biggest arguments out there right now against rates going down is it has to do with the federal deficit, and the fact that rates are high means the government has to pay a high coupon on the debt. Well, those coupons are now going to be shrinking, and I think that is going to become less and less of a headwind for Treasury securities specifically. Lynn Allen would disagree with me on that. I think her views are a little more like doomsday scenario, and I disagree with them at this point. She was right, and now I think she's wrong. Anyway, I wanted to mention, as much obvious extreme volatility there is in the markets today. VIX got up to 30, is now cooled off from there. As much volatility as there is out there, what really is surprising to me is how much the Russell 2000 is actually holding up, even though it was down over 4% today. I'll show you a little trend line there. And Bitcoin is staying solid. And then I like to look at niche, where's the dumbest possible money? Well, I'd say cannabis ETFs. And MSOS is that, and that one's holding up too. And so I'm thinking, especially with this SOM rule, your average everyday person is going to hear about this nonstop over the weekend, and I think this is only the tip of the iceberg as far as how much volatility is coming in the very near future. It's a personal belief, but I do not believe that this is a buyable dip in the stock market, as they like to say. So what can you even say about charts? It's I mean, well, it's a bloodbath out there. But I'll just say, taking high to high in the S&P 500, on a closing basis for right now at 1 o'clock anyway, we're still above this line, and so we're still within this trend, and traders obviously are using this line as a place to buy and make quick profits. I don't expect this line to hold. I expect it to go down from here. With what was going on yesterday in markets, I was sniffing a lot of volatility coming today. Obviously, I correctly predicted that the unemployment number was going to be worse than expected. I said 4.2 or 4.3, while the experts said 4.1. Go me again, pat on my back. And I got some puts actually that expire next week on HYG. At the strike price 77.50, and those have been going up in value so far. This is surprising to me that with all of the volatility, that high yield corporate is still like, oh, everything's fine. It's like that cartoon of the dog sitting in the house on the table with his coffee and with his eyes like this, and the whole house is on fire, and he says, "This is fine." That's how I see high yield corporate right now, junk bonds. But let's move on. VIX term structure. Obviously, with today's extreme movements in the VIX, we are now completely inverted on the VIX futures curve. We're even above. Are we above October now? No, we're not even above October. So the market still thinks there's going to be worse volatility in October than we have today by a good amount, actually. And then, the VIX obviously had a massive move up today. For anybody long or holding calls from UVXY, I was thinking about it yesterday. I didn't make the move, but I made enough moves to benefit from what's going on today. But anyway, the VIX is very elevated here. I wanted to mention, let's put this on a weekly time frame here. There we go. I just wanted to mention that, for trend line basis, we have been having these spikes actually underneath this trend line right here going back to March of 2022, and we broke right through it today, signaling that, the volatility is likely nowhere near over. That, for it to be this low and trending lower and bumping its head on this line for so long, this could act as a big springboard for some really crazy action, especially, like I'm saying, over the weekend. Your average person is gonna look at the news. This is gonna be in the news. I think it will be anyway. I imagine it must be, but who knows? I could be wrong on that. But when they do find out, I imagine that it'll cause more panic next week than you're seeing today. That's what I see in my crystal ball for now. All right, so TLT, obviously, if you've been watching my show, I have over 50% of my assets in this, actually much more now, because my leveraged products have gone way up today. The TLT itself is up on the day by 2.6%, very large move up, again breaking out of this longer term inverse head and shoulders that I've been talking about forever. Again, we gapped over the line. We didn't just break through it, and that gives a ton of strength when you consider chart patterns. And so but I don't know if it'll consolidate here or just going straight up. I'm not certain on that. I kind of hope it keeps going straight up for my own sake. But, whatever. On the flip side, the 30-year Treasury yield, the further this goes down, the higher TLT goes, basically. I mentioned how we cracked and closed below this line today, and it's just like flushing out now. you know. And in terms of like just percentage, like think about this for a moment. The Federal Reserve's target inflation rate is 2%. So any yield above 2% has a real yield to it. Now, treasury bonds you're supposed to be like the most conservative possible investment. And so if you have 2.1% yield on a treasury bond, assuming that the Fed does meet their target of 2% inflation over the next 30 years, for example, you should be getting a real return on that. Now, seeing as though, demographics wise and with technology and everything going on, very strong deflationary forces, for the current yield of 30-year treasury bonds to be still at over 4%, I think is a very attractive place, and will become obvious to more and more investors as we get through this cycle. I think that we could, without too much effort, get down to 3%. Someone had asked me in the comments what's my target on the yield. I don't think 3% is out of the range of possibilities. I don't think 0% is out of the range of possibilities. I don't think negative rates are out of the range of possibilities. Think of what was happening before COVID. We were already cutting. Rates were already super low, and they were already cutting. That's just how our economy has been operating, and I don't think anything's changed. Some people are saying, again, like, we've bounced off the zero bound, and so now we're going through a cycle going the other way. I don't think that's what's happening here. Again, that's a very speculative idea, and it is impossible to predict this kind of thing 100% correctly, but from a psychological standpoint, we're on the other side of the coin from high inflation. Now we're looking at how bad is disinflation, deflation, and people losing their jobs, and people trying to get yield from their investments and their money, which in this part of the cycle is typically harder and harder to find, and until it isn't. And so we'll see how this all works out. Fear and Greed Index on CNN Business, obviously petering on extreme fear. I fully expect us to dive straight into extreme fear next week. Anything can happen over the weekend, but this is my expectation. I forgot to bring this chart up yesterday because the September meeting Fed funds target rate, the range 5 to 5.25 represents 125 basis cut. So that's like one cut, right? Or no. Whoa. Is this right? We're pricing in 2 cuts at 71% now? Whoa. Okay, so this is a bigger development than I was planning to share. I just wanted to say yesterday, notably, how the two cut probability of 50 basis points went from 11% to 28%, but that's now jumped to 71% looking at 2 cuts. So now the market's starting to think, okay, yeah, this is emergency time. And it's, granted, it's possible that this volatility will be short-lived. It's not out of the possibilities that this could be short-lived. I think it'll continue. I've been saying for this whole time as well, we've been expecting one rate cut like 6 months away. And then it's like, oh no, it's still 6 months away. Oh no, it's still 6 months away every month. And keep pushing it out. Now it's the opposite. We're at that point. And now it's expected one rate cut. And then today, 2 in the next meeting. And so, and that can continue, where we have closer and stronger cuts coming in, especially considering how restrictive rates have been from the Fed. They've been very, very restrictive. It's been a long time, historically speaking, since you could get a real return on your cash in the in a money market fund, and That's very, very, very restrictive. Wow. Anyway, let's move on. This could revert. This could be the shocker, and it could be the end of it already. We could reverse and see only one cut. In fact, in a way, I wouldn't be surprised if the Fed comes out with just one cut in September and says, we don't care what the stock market does, which they can and probably should do, especially considering how bad inflation has been getting, and with the fiscal deficits and everything. I mean, this, in a way, it's good news. In a way, it's really terrible news. It's interesting. Finally, the summer's over and we have interesting things to look at. Last two charts I wanted to bring up. Wood, just because it's a good leading indicator, cracked down today. So this market is showing a little bit of weakness. And then IWM, the Russell 2000. I just wanted to bring this up because this line from previous high in 21 that, to previous high in March of 2024. Of course, it's down sloping because we haven't made new highs. I've been talking about how we broke through this line here, and now it's acting as support. So I don't think this line will hold, but this is what gives me extra confidence in more bearishness next week, is because the common man is going to find out about this over the weekend, and I expect kind of a wave of selling next week with the SOM rule and everything. This is one of those periods where we might start seeing news about more banks blowing up as well. But that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching. Robschild.